On Ideas for Profit today, we give you a lowdown on an automotive giant which has continued to stay in the limelight for the most part of the year, especially given how strong its automotive business has been. I'm referring to Mahindra & Mahindra. Now, the company recently delivered its Q2 results and they were largely an inline set. The numbers were driven by the auto segment that partially offset the weakness in the tractor business. The auto segment continues to do well on the back of new and refreshed products. Its order bookings and demand remain buoyant from the medium to long-term perspective. Now, this and the company's strong leadership in farm equipment make it a candidate to be added to your long-term portfolio. Let's take a closer look at the Q2 performance. On the back of multiple launches, the auto segment posted a strong set of numbers. Volumes were up 16% on a quarter-on-quarter basis. Higher volume-led operating leverage coupled with a rich product mix helped the company arrest the impact of cost inflation. In fact, the auto segment posted an EBIT margin expansion of 42 basis points on a year-on-year basis. Farm equipment segment, however, had a difficult time. It registered a 22% QOQ decline in volumes. Its EBIT margin, however, remained flat because of cost management and softening of commodity-linked cost pressure. So, is the worst over for the farm segment? Now, on the back of a superior product portfolio and strong network, M&M continues to do well in this business. In fact, the company gained about half a percentage point market share in the first half of FY23 on a year-on-year basis. Tractor industry volumes are expected to register a 7 to 7.5% growth in FY23 on the back of a normal monsoon and higher water reservoir level. Also, M&M will be able to do better than the industry because of its wide product range and strong new product pipeline. Supply-side constraints have eased and the company is able to bring inventory level back to normal, which is helping it regain its lost market share. M&M also has 15 products in the pipeline to be launched by 2027, which will help the company retain the leadership status in this space. With easing supply chain, the production scenario is also getting better and the demand momentum continues to be very strong, especially for the auto business. Now, this is evident from its order book of 2.6 lakh units so far in November this year. Its recently launched XUV 700 continues to do well. Now, despite the 2-year waiting time, it continues to clock a monthly booking run rate of 11,100. The new Scorpio also attracted customers with 1.3 lakh bookings. Apart from the current launches, M&M also plans to roll out as many as 13 products by 2027, 8 of which will be electric vehicles, which could further drive the growth for the company. It also plans to launch an EV version of XUV 300 in the Q3 or Q4 of FY23 itself. It's important to note or rather highlight that the company has registered the highest ever quarterly electric three-wheelers volume of 10,600 units and had a market share of 67.2% at the end of Q2 FY23. Our SOTP valuation methodology indicates that the stock offers an 18% upside from the current market price, and we advise investors to accumulate the stock on any weakness as well. Of course, like any other company, there will be some risks to watch out for M&M as well. Any weakness in demand in auto and or farm equipment could hurt the company's financials. Additionally, an adverse commodity price movement would increase raw material costs and that could hurt or impact operating profitability. So important to keep these potential risks on your radar as well.